Oh,
He's got two popping in.
poor little dude. Hopefully
No,
he's still pretty, has a pretty good temperament.
he's taking it quite well, actually.
Oh, good for him.
Yeah. Oh my goodness.
Okay,
Hey
well,
everybody, it's Spencer.
hi Spence, how are you?
Hi, Spencer.
Oh, hey y'all.
Okay, I haven't had anyone text me saying, hey, I'm joining. So I say let's just get going, and then if someone pops in late, we can answer questions, but we'll get going. So the idea behind this webinar, it's creative finance for agents. Specifically, we're going to talk about a couple specific types of creative finance. But so the purpose of all of today is that we've just been seeing in the market a higher frequency of these type of deals. And we're seeing opportunities for agents who understand this type of thing, and also a lost opportunity for agents that don't understand it. And many agents as a whole, some understand creative finance and how that works. There are many who don't. And so the purpose of today is just to help educate a little bit. And I feel like the more and more agents I talk to in the real estate space, regardless of the market, especially right now, um, they either know someone or had this situation before where subject to or seller financing or any other kind of creative finance strategy could have helped within a deal that they had. Um, there's actually one, this 16 call case study is what I'm calling it, but it was from a mentor of mine who he had called up an agent. They had a house that was listed on the MLS. It was on the market for 100 days, and after 100 days, they called up and said, "Hey, if kind of got a lowdown on the situation, they said, hey, if we can make sure, Mr. Agent, that your commissions get paid, will your client let us take over the payments of the existing loan?" And the agent just said, nope, nope, not a chance. And so they called 16 times, and every time said, no, no, no. So eventually, after that many times and after so long, the listing expired. And uh, my mentor ended up just calling the seller directly after listing had expired and said, hey, could I take over the payments of your loan and give you some cash and you can go on your way? And they said, absolutely. And so in that case, it was just, like the seller ultimately ended up getting helped out, but for the agent, they missed out on an opportunity where they could have capitalized on a lead and a listing that they already had. So we're going to dive into this in terms of just what is creative financing as a whole. I actually pulled this one from Chat GPT. I figured it'd be fun to see what it had to say. But as a whole, it's just, I'll just read it verbatim. But creative financing is in real estate refers to unconventional or non-traditional methods of securing funding for real estate transactions. It involves using innovative strategies to overcome financial barriers and find alternative sources of capital. Creative financing techniques are often utilized when traditional financing, such as bank loans, are not readily available, or what I've put in bold here is do not meet the needs of the buyer or seller. And that last little part is what we'll focus on a lot more today. So we'll go into types of creative financing. So there are plenty of them, but for the purposes of today, we're going to mainly be talking about subject to a little bit of seller financing, and also a hybrid model of both of those. But now there are other types of, whether it's lease options or you're going going into JV agreements or private money lending or all sorts of things like that. Wraps, novations, all that. We could go more into those things, but for the purposes of it being directed towards agents, we're going to keep it directed towards subject to seller financing and then going over the hybrid of those. So we'll dive in. First one, subject to what is it? And so it's this creative financing strategy and has the nickname of sub to, but it is where a house is purchased subject to the existing loan. And from an agent's perspective, that I found from an agent, if you're explaining this to your client, or even just for your own understanding, it's nice to use this grocery store analogy in which we've all been to the grocery store. It's a little more relatable, but the idea is when you go to the grocery store and I buy my groceries and I go to the checkout, I scan them all and I pull out my credit card, I pull out my Visa, and I use Visa's money to pay for the groceries, right? But when I leave the grocery store and I take those groceries home, those groceries are not owned by Visa. They're owned by me. And the way that the ownership is conveyed is through a receipt. And so in this, we can see a distinguishing factor of, okay, the receipt conveys the ownership of the groceries, but we used American or not Visa's money to secure that. And now there's a debt that is owed to Visa to pay for those groceries. So the same type of thing exists here. When we're going to, in real estate, when you go to buy a house, there you go to a bank and get a loan approved. And so you have a loan or a note of money that is owed back to the bank or to the lender. Now, the ownership is conveyed within a deed. And so in a subject to purchase, the existing loan, you're buying it subject to the existing loan, stays in the name of the seller, and the title is conveyed over to whoever the new buyer is. So it's a little bit different than your traditional come in and grab a loan or all cash to pay off an existing loan. Now, this isn't for every type of situation. And so we'll dive in now a little bit into what the situation or situations that fit for this. And typically you'll see this a lot where there's low equity in the house, where the seller bought it, and especially in light of this market where it was really hot, we had low interest rates, and then as things slowed down and interest rates have come up, especially for people who they may have come or may have bought, a year and a half ago, they put low to no money down, whether it's a VA loan or whatever else. They put low to no money down, and now they don't have a ton of equity in the house. And most often they're in some kind of pinch where they had a life event, some sort of circumstance, and either they need to cash out and move, or they're facing foreclosure or whatever it may be. But in the general situation, you'll see there's low to no equity, and they need to move for some reason. And it's in a market where, like this, where especially in light of if they acquired an interest rate that is much lower than what is accessible today, it can turn out to be a win-win. So the deal is structured basically in that, like I mentioned before, the seller, their name, the loan they've already procured, the loan stays in their name, the title transfers over to the new buyer. And then typically what will happen is whoever the new buyer is will just pay cash out of pocket to whoever the seller is. And we've got a couple case studies. We can go through some numbers here to get some concrete examples here in a minute, but and we can dive more into structure as well if we want. To move forward as an agent, the question is, how do I get paid? I've seen typically two different ways that in this type of transaction, where it's either at closing, it's worked out between the either the buyer or the seller, but typically the new buyer will come in and pay the agent a commission, or upfront at closing. Or there's also, I've seen it where, because let's say the new buyer is going to buy it subject to and then rent it out for a few months. I've seen it as well where over the next 6 months they make a payment of X $100 for the next 6 to 8 months or something like that. So I've seen it both ways, but typically it's easiest and cleanest if it's just right at closing. Works out better that way. We'll continue going through a couple of years on subject twos. These are a couple deals. So this year, as a company at My Tennessee Home Solution, we've done 7 subject to deals. I wanted to just share 3 of them just to show a couple numbers on it. So this first one is off of Rutledge Ford Road. This house out here, you can see it over off to the left, was out in the middle of nowhere. The family had gone through a job loss. They were $10K behind on their payments, facing foreclosure. They weren't really sure what to do. And so they turned to us and looking at, if we break down the math, where they owe $140,000 on the mortgage, at best they resell it for $150,000. They'd already procured a rate of 3.25%, so they had a great rate. And in this case, that's the asset here. Like the house, yes, it's an asset to some degree, but the rate is really the asset for us to look at and to go, okay, we can do something with this. So if you look at it, typically, let's say, had they gone the traditional route of getting another loan to pay off their loan and move on, they would have had to cut a check at closing. Seeing as how they owed $140,000 on their mortgage, they were $10K behind, and with all commissions, closing costs, title insurance, all that kind of stuff. Assuming they could actually sell it at 150,000 and assuming they didn't have to make any other updates to the property, they very well would have had to cut a check. So for us, it was great where we got to come in, give them $10,000, and they were able to walk away and they agreed to keep the loan in their name. Additionally, one thing I did want to touch on as well, then we can, when we get to questions and frequently asked questions, for them specifically, this benefited them on their credit because the loan does stay in their name, it stays on their credit, and their credit was getting dinged because they were missing payments. Now that it's been caught up and each consecutive month after that, it continues to build their credit. So in addition to getting the monetary 10K, their credit is also getting better, whereas before they probably would have faced foreclosure and had 7 years of that on their credit. So on all around, all different purposes and means, it was a win for us and for them. Case study number 2, similar in that they had a life event. This one's out in Springfield. There's a $235K mortgage. Their rate was higher, 6% rate, and they had a second mortgage of $15,000. This is one currently we're actually working on right now, but it's a great one where they're in a pinch with the different things they've got going on. They need to figure something out quick, and so we're able to come in and offer a similar solution, just like the first one. Number 3, this one is up in Clarksville. The family, he's in the military. He got PCS'd down to Texas, and so it's a VA loan. They put nothing or next to nothing down when they bought it. And so in this case, the mortgage was about $240K. It was a 2.6% rate, so very low, which is great. Resale value is about $280. They ended up walking away where we were able to just give them $8,000 and they could move on their way. Another fantastic opportunity for us and for them. And they actually just moved. So I was talking to them just the other day. So some fun case studies. We can dive into math at the end when we do questions, but we'll continue going on. So we talked about subject 2. We're going to talk briefly about seller financing. This one's a little bit different and can often get confused between the two. So seller financing is essentially where the seller becomes the bank. And so I'll tell the story about an F-150, again, from one of my mentors, but I think it illustrates it. And for some reason, when it's cars instead of houses, people tend to understand it better. So if you're ever in a situation as well with your client, and typically in these seller finance situations, if it's not a hybrid, which we'll get there in a minute, the house is, if it's owned free and clear, whether it's inherited or whether they just paid it off, they've owned it for a while or whatever it is. But what it basically is where the seller sells on terms where they get a payment up front and multiple payments along the way, just as a bank would. So in the story of the F-150, my mentor at one point in time was a contractor, and he had this old F-150. He'd used it for years and years and years and years, and he had kind of an emotional attachment to it, as many people do with their houses. And so he figured, it's probably, to me, it's worth about $8,000. And had gone through a lot, and to him, he just didn't want to give it up for any less than $8,000. So he posted on Craigslist, and everyone's coming in offering him, $4,000 or $3,000, maybe someone to $5,000, but it's not what he wants. So the truck is just sitting in his driveway. He's not able to sell it, but then one of his friends comes over and suggests, "Hey, why don't you just sell it on seller finance?" He goes, "Oh yeah, of course." So he went into his Craigslist listing, and he changed instead of just F-150 for sale, he changed F-150 for sale will take payments. And so literally later that day, he sold it for $12,000 total. So more than what he originally had wanted and more than what he was going to get otherwise, but he just set it up to where he got a couple grand up front, and every single month he gets a payment from the new owner. And he continues. In the end, we'll totally make more money from the total sale of it, selling it on seller finance. So like I touched on this before, but moving down to how the deal is structured, it's the basis of some money up front, some sort of down payment, monthly payments along the way. We've got an example down here of a house. Let's say the resale value is about $300,000. Whoever the buyer is, they can bring in about 10% or whatever percent that you agree on. A lot of this is negotiable. But if they bring 30K down, they amortize whatever the rest of the loan payment is for, you know, the rest of the 30, or if you amortize it over a certain amount of period of time, then depending, but typically 30 years, brings you about a monthly payment of $14.49. There's also something called a balloon payment, in which even though during those monthly payments, when you get to year 10, you're not going to have all of that 300,000 paid off. But the idea is that at whenever the balloon is, that is when the remaining amount of the loan is due. So it can be 5 years, 10 years, because some people may like to be the bank, but if you're really gonna only want to be the bank 5, 10 years rather than 30, it's a good opportunity and a good way to fit that in there to get all your money back. So the buyer at that point, at the end of the balloon, would either sell it or refinance it or whatever it may be to get the remaining money back to the seller. And of course, there's interest on that payment as well. As an agent, similar type thing where they can get paid either depending, I mean, similar as with the subject to deal, whether it's just a commission paid at the end at closing, or whether it's monthly payments along the way as well. Again, cleaner to do it just at closing, but you can work that into the deal as well. Fun thing about specifically with seller financing, because often as an agent, you get paid on a percentage of the sales price. Typically a buyer, if they're selling on seller finance, they can offer more because they're making payments along the way, which results in a higher sale price and also therefore a higher commission percentage. But we'll keep moving on with that. The reason I bring up seller financing, not that it's as common in this market, but it's just to kind of intro into a hybrid, which is subject to and seller financing. So we'll walk through this example where we put both of them together. So we'll say this house specifically, in this example, is the resale value is about $450,000. The seller owns 300, or still has a loan amount for $320,000. So they do have some equity in the house. So if they were to do a subject to purchase, it wouldn't fully make sense for them to just walk away with just a little bit of cash, like on the other ones we saw where it was 10,000 or less. They'd be leaving a lot of money on the table here. So in this case, in this example, there's 200 or 2,300. That's the payment to the bank that the current seller makes every month. And if you factor in closing costs, then there's about $66,000 of equity left after a down payment of $50,000. So in this case of a hybrid deal, whoever the buyer is would come bring a down payment of $50,000 up front, and then they would take over the existing payments of the loan and make an additional payment to the seller in a second position note payment that would be cut at closing of about $317,000. Obviously, with interest rates and how you want to structure that number can change. And then you can also set up a balloon payment for X number of years as well. So in this case, if there is someone that they would like to make some money off the property, they've got a good original percentage rate on their existing mortgage, it's a great opportunity if they're okay with their debt to income ratio and credit, having that on there, and assuming whoever you're selling to is trusted. It's also a great way where it's truly passive income. So that's the hybrid model. So if there is equity, but from a tax perspective or whatever else, especially if it was a rental property or whatever, that's a great way to make some more money from that if there is equity in the house. So we'll move on here. We'll go into a few frequently asked questions, and then I'll just open that up. 2 questions for anyone who has questions, and then we'll try to get you guys out of here. I know we said an hour, but you could probably get out of here sooner. First frequently asked question is, what about the seller's credit? I touched on it a little bit before, but the main part is that yes, because in a subject to transaction, not as much on a seller finance, but on a subject to transaction where the loan stays in the name of the seller, their credit is for good and for bad. The loan is still on their credit. So if payments are made every month, which is generally what happens, that boosts the seller's credit. Now, if for some reason a payment was missed by the new buyer buying it subject to, it could very well hurt the credit of the seller. However, what you can do to help protect the seller in those cases is at closing, you can have the title company drop a performance deed or a deed in lieu of foreclosure, which basically states that if the buyer defaults on a payment, they can take the performance deed down to the county recorder's office and have the property deeded back to the seller in lieu of having to do a full foreclosure. So now that is one thing that does protect them. But on the most cases, and I don't know if I've ever seen it yet, but most cases, if the buyer is going to come in and spend the money to pay the agent, to pay the seller, it is very much in their interest to keep the house, where that is the asset, and keeping the loan and that setup is what's going to make them money. So they have zero incentives at all to default. But in that case, we also can protect the seller with a performance deed. Next question is debt to income ratio. Like we mentioned, if in a subject to transaction, if the loan stays in the name of the seller, then therefore, if they go to try to buy another house, another car, would that show up? Yes. The answer is yes. Yes, it will. There's a couple of ways to get around it. So if I'm going to buy a car and they say, hey, you have this whole mortgage on your credit still, couple ways around it. Number one is that if, let's say, perhaps if I go and I'm the buyer, I buy a house subject to, my sellers go off to buy the car. If I, as the buyer, am renting the house, I can just send the lease agreement over to them and they can count that as income towards the property. They'll count about 75% of the rents, the gross rents, towards that, which should counteract it. Assuming cash flows, right? If not, then the other option that you can do, and now I can't, and my disclaimer is that I can't speak for every mortgage officer out there, but in the general sense, what you can do is you can get a servicing company, whether it be Westar or Evergreen or whoever, a third party who will set up the servicing from, if I'm the buyer, from me as the buyer, will pull from my bank account and continue to pay the mortgage, right? So they are a third party that's just processing payments every single month. Now, what we can do is if we set up servicing, we can have the third party servicing company send a proof of payments that is coming from a different party than the original sellers to whoever the loan officer is. And in most cases, I would say it has been that after so long of, I believe it's 3 months, it's 25%, and after a year, they can knock off all of that off their debt to income ratio. But yes, that is the thing, something to be aware of. So in most cases, it makes the most sense to, if the sellers are, instead of going from selling their house subject to another house, that one doesn't quite work out as often. But if they're going to rent, then that is a perfect scenario where that could make sense. They won't hit an obstacle. Next frequently asked question is, what about the due on sale clause? And so for those of you that may not be aware, the due on sale clause is in, I believe, all conventional lending documents. So where it is that whoever the original lender is of the house, when they lend on the house, they put in their mortgage documents that they have the right, not necessarily the obligation, but the right to call all of the mortgage due on a sale of the property. So if they see that there is a sale from one party to the other, like a subject to transaction, they have the right to call the note due within 90 days. Now, in most cases, they won't do that. Reason being is just the practicality of it is when banks, they want good paper. They want to see, if the mortgage payments are being made every month, they're happy to see that. Most of the time they won't even know, but even when they do, I talked to another investor here in Middle Tennessee, where she owns a lot of these subject to deals, and she's talked with the bank about it, and they said, hey, like, as long as the payment's being made, we don't care, right? So now that does vary lender to lender. Typically, if it's a small, bank that is keeping their loans in house, they'll probably call the loan due. But if it's a Wells Fargo or a Rocket Mortgage or whoever, they've got millions of loans, typically that doesn't come up. But if it does, there are a couple of things you can do to get around it, whether it may be due on sale insurance, whether it may be, and most of this is talked about, you can talk to the lender if they're about to call the note due. You can deed the property back to the seller and sell on a land contract or agreement for sale or whatever they call it here in Tennessee, where the buyer retains the basically the the control of the property, but the deed is not in their name. So that does have a distinguishing bit of tax benefits that are adjusted there, but that is one thing that works there as well. So there's a couple ways around it. I would say from what I've seen in my mentor specifically, I was on a Zoom with him the other day where he had said that of the 3,000 that he owns, the 3,000 subject to properties, single family houses, he's had the due on sale clause called 5 times. However, I have seen before where if it's a reverse mortgage, it'll get called every single time. That's a little bit different, but so yeah, last question, frequently asked questions before we open it up to everybody. What does the paperwork look like? The basis of the paperwork is in that it's just a normal purchase and sale agreement, and then there's a disclosure and acknowledgement page for the ones that we use. I mean, that's the basis of it, but it's specifically based around, you know, subject to purchase. So pretty straightforward, pretty simple for those agents out there, of all you watching. If you'd like to look more at it, when we come into a deal, we'd be happy to go over it with you. So that is all that I have. But I do want to open it up for questions if anyone has any, or if I went too quick and we need to go over something else again, I'd be happy to do so. But any questions out there?
I have a question.
Go for it, Linda.
Can you go back to the one where you discussed the soldier? How did you purchase that property? That one?
This one was a subject to purchase. So we took over the loan.
So you took, was it a VA loan?
Yep.
Okay, so how does that work when they PCS to their next duty station and they go to buy a property? Now they're limited on their property price that they can purchase due to the fact that they already have one VA loan out there. So they're only entitled to the remainder.
Right. So they still have, and we could talk that over with them about entitlement and that kind of thing. So where we had talked through, and the amount that they had left, they felt comfortable with that amount to where they were moving. But they also had told us that they planned on renting for at least another 5 years. But yeah, valid point there on a VA loan. That is very well a thing. But we had previously had that conversation. They felt comfortable with it.
Okay.
Sweet. Well, thank you, Linda, for that question.
Mhm.
Any other questions from anybody? Okay, if not, then we can just call it a day. And I thank you all so much for coming. If you have any other questions in the future, if you come across a deal, feel free to reach out to me or give, any of us at My Tennessee Home Solution a call. We'd be happy to talk. But thank you all so much and have a great day.
Thank you. Have a great weekend.
Take care.
Yeah, that would be no.